good evening, viewers. I'm Chaiti Narula. You're watching the Business Today show, and let's start with the top headlines first. Stock markets fall on weak global sentiments. Nifty and Sensex both down over 1% each. Banking shares down after RBI rate hike. Investors take shelter in the pharma sector. Is another Lehman Brothers moment around the corner? Credit Suisse, one of the world's largest investment banks, teeters on the edge of collapse. Stock down more than 12% in one day. CEO says the bank is at a critical moment. The crude oil prices surged more than $3 amid speculation that the OPEC could slash production by up to 1 million barrels per day later this week. This will be the second cut after a reduction in August. EMI shock for home loan borrowers as bank raise interest rates by as much as 0.5 percentage point. Business Today TV does a number crunch and tells you what to do with your loans. Big U-turn by the British government just 10 days after the budget rolls back the removal on tax on the super rich, even as calls for bring back Rishi Sunak resound on social media. The market started the month of October on a somber note. Weak global cues roiled the sentiment on the Dalal Street. The investors booked profit after Friday's rally, and the Sensex tumbled 638 points to shut shop at 56,789 levels. The Nifty too slipped 200 points, ending below the 16,900 mark. 42 Nifty stocks were in the red, with Adani twins being the top losers. All sectoral indices, as you can see on your screens, ended in red, excepting Nifty Pharma. Other blue chip laggards included Eicher Motors, Maruti Suzuki and Tata Consumer. ONGC and BPCL surged following windfall tax cut on crude oil production. Cipla, Coal India, Dr. Reddy's Labs also helped trim losses. Our global business editor, Udayan Mukherjee, now joins us. Udayan, what do you make of the market that has been volatile for a while now? Is this a trend that's going to be continuing going forward? What's your opinion?
Well, markets are at a very interesting juncture at this point because we've had a brutal fall from 18,000 to 16,800, and that 1,200 points on the Nifty came really quickly. So I think it knocked out a lot of people in the market, traders especially, because at 18,000 there has been a lot of optimism that we are heading towards new highs. The markets put a bottom in place, and then suddenly this 1,200 point drawdown led by global markets, of course, I think actually caught a lot of people or traders on the wrong foot. The market's taken support at 16,800 or thereabouts expectedly, and it's given a bit of a bounce back. I think it's very crucial now how it negotiates this 17,000 Nifty area and whether it manages to consolidate and put some kind of a floor in place because there is considerable turmoil out there in global markets. Volatility is rising every day out there. The pullbacks in the Western markets are reminiscent of bear market pullbacks, so there could be more pain ahead out there. It's too early to say whether our markets are headed back to retest the June lows of 15,000 or 15,200 on the Nifty. We are quite a bit far away, 10-12% far away above that level. But valuations are not very supportive. Global tidings are not great. So I think it would be very important to be cautious at this point in time and not get carried away, despite strong rallies of the nature that we saw towards the end of last week. I think there is considerable uncertainty and volatility in the air right now, and taking large trading bets either way, I think is fraught with a lot of hazard. The market still needs to find its feet and settle down. And the best case outcome for this market at this point is consolidation, not a hasty pullback to the 18,000 level on the Nifty. I don't think that should be the base case for now, at least.
Well, thank you, Udayan, for that. As Udayan rightly mentioned, global uncertainties, rise in crude prices, strengthening of the dollar, and several other factors are now making the markets volatile. Where can investors really park their money to hedge over this volatility? Our global business editor, Udayan Mukherjee, spoke to Atul Suri, the CEO of Marathon Trends, about the current market condition and where can we find value going forward. Listen in to this excerpt of the conversation.
it must be a confusing time, even technically for you, because just last week we were talking about 18,000 Nifty and the possibility of new highs against the run of play, and there has been a very sharp 1,000-point setback. How do you feel about the market now? Do you think new highs are possible anytime soon, or is a retest of the June lows a greater possibility?
So if I look at markets, it's difficult to look at it just secular as India. I think you have to look at the global scene, because we know that the bigger movements that are happening are global. The positive is that obviously India is doing better than most global markets. But when I look at global markets, I look at something called the All-Country World Index. This is a summation of around 49 global markets. And what is visible is that there is a correction across the globe. It's almost about 20%. And the interesting part is that we have or are in a correction that's a good time and price-wise correction. Time-wise because, the last highs were almost a year. So a year has passed since we've revisited the previous top. And second is that if you see the size of correction, we may call it a percentage, but the All-Country World Index has gone below the pre-COVID top. So, in Jan 20, when COVID hit and markets fell off the cliff, in fact, the markets have gone below that. And if you look at a lot of subsets, like especially the European place, they're well below the 2020 top. So there is a lot of damage that has happened price-wise and time-wise. And the silver lining in all this is obviously that the markets are extremely oversold. There's extreme pessimism. And when you go and dig down and do some more work, as I said, that's probably the silver lining, because there are dark clouds all over. As I said, we've had a big time correction, we've had a price correction. The news is horrible. There's really no good news at the moment. But in all this, I think one of the big things that we've gone and done historical studies, I can talk about it, that we are at such extreme oversold levels that historically we've seen that in such points of pessimism, deep oversold levels, very often the markets surprise on the upside. So at the moment, as I said, I'm not calling the bottom, but the risk reward is very much in favor of somebody who is not trying to short sell at this level or not surrender his portfolio at this level. Probably hold on to what you have, and if you've got spare money, again, without trying to find the absolute bottom, interesting place to look for opportunities.
I take your point about pessimism, Atul, but 20% is actually a garden variety bear market. I mean, look at the previous vicious ones. I mean, forget 2008, which was 50% or more, greater than that in many markets. 30-35% is pretty par for the course for a proper bear market. In that sense, do you think there could be even more price damage before the dust settles on this one?
I think that the price damage may not be immediate. So let me tell you why I'm saying that. I feel that we are due for a leg up. Now, how much that pulls up, that's a different story, because we know that bear markets can also have multiple legs. So let me tell you why I am not so bearish in the immediate short term, in spite of all the negative news. I mean, you couldn't have it worse than Credit Suisse news on Saturday and kept many market participants very active over the weekend. The reason is that we know there is something called, for someone who looks at technicals and charts, there's something called a 50-day moving average. It's a very good intermediate trend study. And when you look at the S&P 500, I call S&P 500 the mothership because it's the top 500 large caps in the US and some of the biggest names in the world. You will find that the number of stocks above the 50-day moving average is about 3%. When we go back and look at the last 15 years, Udayan, you'll find that these low levels are last seen only 3 times. Once in 2008, second in as recent as 2020, and once in 2010. So when you do these kind of things, you are able to ascertain that where are the points of extreme pessimism and optimism. It works the other way around also, when 90% of the stocks tend to have positive readings. So what we are seeing is extreme negative readings in terms of, as I said, this market is extremely oversold. I mean, it's just waiting for some positive news. Yes, is it going to be the final fall? That only time will tell, because there are too many things at play. There's commodities, there's currencies, there is bond yields. So the play and the problems are plenty. There's a recession one day, inflation the other day. So one is not calling the absolute bottom, but I feel at this point in time, I think it's not a time to be extremely bearish, but rather look at it opportunistically. And on this, you overlay the relative outperformance of India. So I feel that that is again a very, very interesting scenario that is happening out. I know historically you have pulled out some numbers. Historically, we know we can't dealing for very long. But I feel that we are reaching that point of a certain amount of capitulation, a certain amount of extreme pessimism point. And in the past, as I said, historically, we have seen that these tend to be points where the market actually surprises you on the upside. So the attraction is not about finding an absolute bottom, but the attraction right now is the risk-reward ratio.
Fair enough. And we'll talk a lot about the dollar index and the S&P 500 in a minute, Atul, but I just want your thoughts on the Nifty quickly, because that's very widely tracked and of great interest to our viewers. Do you think the market will find a temporary bottom around just below 17,000, or do you think a fall to 16,000 or sub 16,000 levels is likely this year?
I think we would find a bottom pretty soon. As I said, that this bottom is not going to be linked. This whole delinking theory is good in the short term. You may have some relatively good days and bad days, but over a long period of time, you will find that when you overlay markets, you will find that 2020 nobody was spared, 2008 nobody was spared. So when the bigger moves happen, nothing gets spared. It's just the quantum that goes. So even I think that the Nifty is not going to itself make a bottom. It's a secular bottom, not really. It will pretty much coincide with global markets. And so this whole, I feel that, as I said, I don't know the exact timing, I don't know the date, but I do feel that we are at points of extreme pessimism, extreme oversold. And if global markets bounce back from here, I feel Nifty will bounce back pretty sharply. And what's very interesting is that the distance, one is of course the level of 18,600, which was the earlier high, which obviously is a beautiful line, it's all well known. But if you look at the fall that has happened since the market topped in September of last year, you'll find that there's almost a vertical channel. And just till a few weeks ago, we went and almost broke out of that level, which was around 18,000 or so. So I think that if we break out of this channel, there is a very good challenge to lifetime highs. So my optimism comes from two areas. One is the extreme oversold nature of global markets. Second is India's relative outperformance. And if the first works out, I feel that India can surprise on the upside. Why I feel that India will surprise on the upside, and it's not just about a day or 2 days. We do something called ratio charts. Ratio charts are just comparison between two big indexes. So, we've done some ratio chart work, just as I shared earlier about the 50-day moving average. We do ratio charts of the S&P 500 versus the Nifty 50. And we'll find that the Nifty outperformed the S&P 500 from 2003 to 2008. But post 2008, the US markets, especially the S&P 500, has outperformed the Nifty. But what we are seeing in the last month or so is that, if you look at the graph, this is after a decade, the Nifty has started outperforming the S&P 500. So if you draw a horizontal line on the ratio chart, so these are things which don't happen for a week or a day. These are decadal moves. And when such decadal moves happen, they rarely disappoint. So what I am also seeing is that after a decade of relatively underperforming the US, India has still done well, but relatively underperforming, I think the time for India to outperform has come. So, for investors' point of view, last year everyone was rushing to invest in global stocks and invest in the NASDAQ, very popular ETF. But I think the time for investors to look at India as a relative outperformer has come. And as I said, I'm not speaking about a week, a month, I'm speaking for a longer period of time. So, coming back to your question, absolute bottom nobody knows, but I do feel that if global markets stabilize, India will really surprise on the upside, because we are almost entering a multi-year phase where India will outperform the US markets.
You know, a thing which a lot of people track these days very closely, Atul, is the dollar index, because the dollar has been so strong against most global currencies. Do you see any kind of topping patterns out there? Because that would be a fairly bullish outcome for not just the rupee, but possibly even Indian stocks.
No, I don't see the dollar settling very soon. In fact, it's in a tear, and I feel that there is still more upside. This is going to be a very big overhang on risky assets. I mean, it not just is equities. It gets even worse for emerging markets, because probably the worst bunch globally is actually the whole EM space. Unfortunately, India is a subset of that, and that to some extent really guides the whole FII selling that there is. So a stronger dollar is definitely not good for risky assets. At the moment, as things stand, no, the dollar seems to be extremely strong, and it is the worry point. As far as bond yields go, you know, another area which is linked to this, the US 10-year, if you look at it, I do feel that it's not going to have that runaway. You know, we saw this move from 50 bips to 3.5, 3.6 or whatever, that there is almost like a 7x kind of move. But I think that area is going to be a little muted, little settled. The lid is on. But as far as the dollar goes, I still think that there's more viciousness in that tail. And that, if you ask me, is the single chart that worries me globally, is really the way the dollar index is poised, because that is not, you know, sort of topping out like commodities. You know, a few months ago, commodities were the big issue, but if you look at commodity, they seem to have topped out, and they are actually correcting. Bond yields, they seem to be flattish. Dollar is the pain point or the worrisome.
And you can watch the entire interview on businesstoday.in and our YouTube channel. Credit Suisse shares have fallen by more than 10% in the opening trade today, reflecting market concerns ahead of a restructuring plan in the third week of this month. The bank, along with Deutsche Bank, took a big hit when bonds in the UK plunged last week, with many fearing the two may go the Lehman Brothers way if urgent corrective steps were not taken. According to the analysts, two banks had $2.7 trillion as assets under management, a fact that is making many nervous. Deutsche Bank was nearly down 3% at the beginning of the trading session today. Now, home loans have become more expensive from today. A clutch of banks, led by the State Bank of India or the SBI, have hiked their repo-linked lending rates by a hefty 50 basis points. Seen in isolation, the hike may not seem too much, but since April, home loan rates have risen by more than 1.5 percentage points, and the pain is only going to get worse in the months to come. Here's a look.
Do you have a home loan, or do you plan to take one? Be prepared for a much higher EMI in the coming months. It is a nightmare scenario coming true for home loan borrowers in India, with central banks around the world, including the Reserve Bank of India, on an interest rate hiking spree. EMIs have increased sharply in 4 months for borrowers, with the RBI adding a 50 basis point hike to its 1.4% point increase since May. All major lenders like the SBI, HDFC, PNB, Bank of Baroda and ICICI Bank have passed on the burden to borrowers. And with the Reserve Bank expected to increase rates even further to combat inflation, the financial pain is set to get worse.
In most cases, I think you should prepay the loan rather than, invest it somewhere. I have never been a believer of this opportunity cost of investment being higher, and therefore don't prepay, simply because yes, investments could give more, but then you're taking a risk to be able to get that higher return from an investment.
Business Today TV did a deep dive into the financial implications of the rate rise, and what we found is shocking. Let's assume the home loan is for 50 lakh rupees for a period of 20 years, with interest rates rising to 8.6% from 6.7%. When interest rates rise, the lender offers you two options: raise your EMI or increase your tenure. In the first option, keeping the tenure the same, that is 20 years, the EMI rises from 37,870 rupees to 43,708 rupees, a rise of a whopping 5,838 rupees per month. This entails a rise in the interest outgo over a period of 20 years to nearly 55 lakh from 41 lakh rupees on a loan of 50 lakh rupees. In the second option, often chosen by borrowers, if the EMI is kept constant, the loan repayment tenure rises to 30 years from 20 years. But it's the interest pay outgo that actually boggles imagination. It rises to an incredible 89.68 lakh rupees.
Sometimes banks by default increase the tenure, and that's a very hurtful point for the investor or the borrower. So I think it's the onus of the borrower to inform the bank that to not increase the tenure, but retain the same tenure, increase the EMI if they are able to afford that.
Meanwhile, with the housing sector still to emerge from the pre-COVID slowdown, there are real fears that the sharp rise in home loan rates could deal a body blow to the sector. Not only will investors stay away from real estate, final buyers will also think twice before approaching a bank for a loan. Bureau Report, Business Today Television.
It has not even been a month yet, and British Prime Minister Liz Truss's government is now facing massive humiliation with a U-turn on a tax cut that led to disastrous consequences for the pound and forced the Bank of England to spend £65 billion to stabilise government bonds. This has spawned a new rallying cry across the United Kingdom. Bring back Rishi Sunak. Here is more on the story on why the Brits are missing their former Chancellor of the Exchequer.
Just 10 days after the British budget was presented, slashing taxes on the super-rich as a way to jumpstart the country's economy, the British government has been forced into a humiliating U-turn. The removal of the 45% tax bracket without a plan to make up for the revenue loss pulled the rug from under the pound. The stock markets triggered one of the biggest sell-off in British bonds. The rollback announced by Finance Minister Kwasi Kwarteng brought back some stability to the British markets. Along with an onslaught of memes and ridicule on social media, resign was a top hashtag on Twitter most of the day. While £65 billion, the amount estimated lost in the past few days, was one of the trending phrases.
A lot, as you know, can happen in a fortnight, and how challenging it's been, the pound falling, bond markets in a mess and business confidence low. Until 2 weeks ago, the most damaging thing Kwasi Kwarteng had ever done was swear on University Challenge. To be fair, Liz Truss did tell us she was planning to hit the ground from day one. She just never told us she was taking the pound with her.
Also trending heavily on social media, calls to bring back Rishi Sunak, the Indian origin politician who held the post of the Chancellor of the Exchequer during the challenging COVID period of February 2020 to July 2022. One of his pre-election debates with Liz Truss has been also doing the rounds.
For the new Prime Minister and the new government is to grip inflation. We cannot make it worse. Inflation is the enemy that makes everybody poorer. It erodes your savings. It erodes your living standards. It means that those of you that have mortgages will see your interest rates go up higher and higher. So I don't think the responsible thing to do right now is launch into some unfunded spree of borrowing and more debt. That will just make inflation worse. It will make the problem longer.
Let's be clear. We have inflation because of our monetary policy, that we haven't been tough enough on the monetary supply. That's the way I would address that issue. Okay. But it is wrong.
Interest rates up, mortgages nightmare.
It is.
Liz, we have to be honest. We have to be honest. But borrowing your way out of inflation isn't a plan. It's a fairy tale.
Meanwhile, faced with an erosion in investor confidence, the duo of Prime Minister Liz Truss and her finance minister are trying their best to convince the international community the British government was focusing on building a high-growth economy with opportunities for all. Bureau Report, Business Today Television.
Well, that's it from me, Chaiti Narula. Keep watching India Today. For more news and updates, don't forget to log on to indiatoday.in or go ahead and download our India Today app.